RateGain, the largest software as a service or SaaS company in the travel and hospitality sector in India, helps travel brands maintain rate integrity across multiple points of sale online, forecasts demand and manages their online reputation and distributes their rates too. The company offers interconnected products that manage revenue creation value chain for customers by leveraging its big data capabilities and integration with other tech platforms, helping hospitality and travel providers acquire guests, retain them and seek to maximize their margins. Of the three key verticals under DaaS, which is Data as a Service, RateGain provides competitive intelligence and parity intelligence to help hotels and travel suppliers stay competitive and optimize their revenue. Clients subscribe to DaaS products such as Optima and Parity Plus. Under distribution, it provides tech infrastructure that helps both hotel chains and demand partners such as online travel agents communicate availability, rates, inventory as well as process bookings. Finally, MarTech provides social media management to leading hospitality and travel brands, offering real-time social listening and guest communication, active management of their social assets, and campaign management through AI-based solutions. RateGain recently completed the acquisition of My Hotel Shop, a company which offers reporting, bid management and campaign intelligence platform for meta research publishers and other travel products that enable hotel suppliers, OTAs and agency clients to reach more customers at higher returns. Despite being seasonally the weakest of the four quarters, Q1 FY23 saw the company report a decent set of numbers with revenue growing by over 10% sequentially. Signs of operating leverage are visible as this was achieved with only 3% QOQ increase in employees. Despite a significant 20% sequential rise in employee expenses, EBITDA margin compression was very much in the guided range. The key growth engine for the quarter was the MarTech division, showing a sequential growth of 17%, followed by distribution growing quarter on quarter by 9%, and DaaS, which was almost flat with a 2% QOQ growth. Higher share of MarTech with lower margin dampened gross margins for the company. It expects MarTech to contribute close to 50% of revenue. However, as the business grows, margins should also improve on scale benefits. Q1 saw a surprise revival of business travel that improved its share in the overall scheme of things. In terms of geography, on a sequential basis, Europe did extremely well, although US, with a share of 54% in total revenue, maintained its leadership. The client mining engine appears to be doing well, with a share of top 10 clients improving to 36% of sales compared to 34% at the end of March 22. Business outlook continues to improve, with the company adding 72 new clients in MarTech, 64 in distribution and 65 in DaaS, although the overall net client addition of 8 looks muted as the company decided to rationalize unprofitable accounts. Order wins and pipeline showed QOQ improvement. In line with the tech sector trend, attrition remained elevated at 22.3% but did not worsen on a QOQ basis. However, with revenue outpacing headcount growth, revenue per employee has improved. At the end of Q1, the company maintained its guidance of at least 30% organic revenue growth and steady margin improvement in the next 3 quarters, with blended EBITDA margin in the vicinity of 12.5% for the year. In the current macro environment, all industries, including travel and tourism, are using technology, especially AI, machine learning-driven products, for revenue maximization. What could work for the company is the lower client overlap across the 3 businesses, which opens the door for cross-selling. The company has high revenue retention rate at 90% and has recurring revenue orders of 98-99% in all the 3 verticals. Should there be a significant impact on consumer expenditure due to faster than expected rate hikes, the company doesn't expect significant reduction in travel spends. Moreover, with only 23% of revenue being purely transaction-driven, the overall impact on revenue is likely to be limited. At most, new client addition could see a temporary slowdown. RateGain's inorganic strategy is driven by the quest to acquire domain expertise, offer innovative technology and new capabilities to customers, and to fortify its presence in travel and hospitality industry and its key markets. Remember, the company raised 375 crores in IPO, and after the debt repayment of 110 crores, it now has a debt-free balance sheet and has cash and equivalent of 417 crores, enough to drive opportunistic organic moves. Sectoral tailwinds are strong and the company is geared up to maximize this opportunity with its own suite of products and possible addition through inorganic route. The company expects significant margin improvement once revenue scales up to $100 million and is guiding to EBITDA margin in the vicinity of 25% over the next 3 years. We see strong earnings traction for RateGain. However, its valuation on trailing price to sales at 8.3x is now at a tad premium to its much larger peer Amadeus that's trading at 7.1x trailing price to sales. We advise investors to add the stock gradually on decline as tech shares tend to gyrate amid global central banks' war against inflation. Of course, like any other company, there will be some key risks to watch. Macro challenges impacting the addressable market is one of them, and heightened competitive intensity dampening growth and margins will also be a potential risk to watch out for.